The greatest bubble ever about to burst. Michael Burry is back at it again, and this time, he's tweeted out a number of cryptic references to what he feels is the inevitable stock market crash, coupled with things that make him think that it's going to be that bad. Michael Burry, the four-time New York Times best-selling author and real-life investment genius, has been warning his followers over and over again about a recession in 2023. The global economy is stagnant despite the presence of higher interest rates and heavy central bank stimulus programs. This is not an environment where the world's economy can enter a genuine recovery because there's no magic elixir that can make debts disappear. The recession of 2023 has only just begun, and it won't end anytime soon. Various aspects of the economy are already starting to experience the aftershock of the stock market meltdown of 2023. Hi, you've reached Finance Sense, the place where we discuss all the most recent trends in the financial markets and the economy. In this video, we'll discuss the meaning of Michael Burry's cryptic tweets and how the federal government caused inflation to get out of control to the point that it would cause a market collapse. But before we get started, make sure to give this video a thumbs up, hit the bell notification button, and subscribe to our channel so that you can stay up to date with our new videos. Having said that, let's get started. The predictions made by Michael Burry are turning out to be correct. Michael Burry made an accurate prediction about massive inflation and a catastrophe on the stock market at the beginning of 2021, but hardly anyone listened to him. Because of the extreme inflation in the United States, the Nasdaq has lost 32% of its value since January, while the S&P 500 has lost 23% of its value. Despite the passage of another year, the problem has not been resolved. Since Dr. Burry issued his warning to investors about the imminent threat posed by the market has declined by an additional 15%, and he's not yet finished with his prophecies. Dr. Burry recently tweeted, "Nowhere near rock bottom yet," which may be seen as an implication that investors are not taking the current crisis seriously enough. Something far worse is still to come, and in order for people to survive the coming financial storm, they need to understand why Dr. Burry is so concerned, as well as the logic behind his predictions. According to Michael Burry, there are three elements that might lead to an even more severe economic collapse than in 2008. Because of these three contributing reasons, Michael Burry has sold off the majority of the stocks in his investment portfolio. In a tweet, he stated that inflation's inherent nature causes it to momentarily deceive the general public before returning to its previous level, not the president or the Federal Reserve Board. As we may recall, the inflationary cycles of the 1940s and 1970s are interrelated due to the fact that a recession followed the first rise in inflation, which caused governments to print money in an attempt to stabilize the economy. If you continue to act unknowingly, inflation will come back much worse. The credit goes to the velocity of the money. The value of the money supply is determined by the GDP divided by the total money supply in the economy. To illustrate, let's say that over the course of 1 year, this made-up economy managed to sell $3,000 worth of cake at a price of $10 a slice. The GDP is $3,000 multiplied by $10. As a result, let's make the monetary base $10,000. To calculate money velocity, divide $30,000 by $10,000. Considering how much the money supply has expanded over the past several years, it's astonishing that money velocity has not also increased. After a period of relative silence in 1978 and 1979, velocity has grown despite quantitative tightening and rising interest rates, both of which have contributed to a slowing in M2. Because velocity increased at a faster rate than the money supply, inflation increased, which made the redux shocking. Burry revealed in a graph that inflation is cyclical and will become more severe if money printing increases and inflation reaches 15% in the 1980s. He also showed that this scenario is highly possible. From the beginning of time, peaks have been peaky. Therefore, it recovers quickly from a period of deflation during the 1940s and 1950s, or a collapse during the 1970s. Inflationary cycles often run for a number of years, whereas periods typically span for decades. Furthermore, the GDP of the United States has expanded on a yearly basis, and the GDP grows alongside the CPI. If prices continue to fall over the next few months, the economy will come to an end. Some individuals will be hit harder than others if the economy continues continues to decline. Unless it was the Federal Reserve, the person who dropped it is not liable for the consequences of their actions. The Fed encourages people to avoid spending, and the spending habits of the government haven't changed. This will add to the expenses that Biden already has to pay an inflationary surge. Burry stated in a tweet, "We have a phenomenon. The fiscal put, which is now used for more than just spending, will be beneficial to the economy of the United States in the same way as sugar is beneficial to babies." Burry tries to explain the present economic problem by comparing it to sugar consumption. Giving a newborn anything sweet can make him feel better in the short term, but over time, he'll develop a tolerance to sugar, which is bad for his health. In July 2022, the White House provided a new definition of recession. The low unemployment rate of 3% in 2020 provided sufficient justification for their choice. Economists believe that a reduction in the unemployment rate from 15% to 3% is beneficial to the economy. Moreover, the unemployment rate is considered a lagging indicator. As a direct result of the recession, the unemployment rate will soon continue to rise. The market for white-collar jobs is collapsing, and the length of time that layoffs continue to occur determines how long the current economic crisis will continue. Employees who work from home will likely be held responsible for the looming employment crisis, which will have a negative impact on the economy. However, there is an even more significant problem that has to be addressed. Leverage in electronic trading, or e-margin leveraging, takes place when investors use borrowed money to buy investments. For example, placing $50 into a brokerage account and then borrowing another $50 as a margin loan isn't necessarily going to do any damage, but it is risky. Additionally, a portfolio with a growth rate of 60% generates $110. If the value of your assets goes down by 60%, they are worth $10 less. When your portfolio reaches a negative value, however, margin calls are not triggered. Rather, they occur when your equity falls below a specified level. If additional funds are not deposited, the broker has the right to sell the client's shares at a higher price and without prior notice. When things are trending upward, the margin can be beneficial, but it can be pretty detrimental when things are trending downward. Alternative investments, such as options and futures, are more volatile than traditional investments, which may result in the greatest margin bubble in market history. When an investor's broker sells assets and drives down their value, the investor will receive a margin call. This makes it possible for more individuals to receive margin calls, which results in decreased prices and an increase in margin calls. In the past 5 years, the total number of credit card bills has increased to 4.6 million, which has made the problem even more severe. The availability of credit cards is a driving force behind this meteoric surge. Goldman Sachs views the current economic downturn as a form of regressive taxation that primarily affects lower-income individuals. For this reason, AIG had to be bailed out in order to protect Goldman Sachs from the other subprime crisis, which everyone believed wouldn't be contagious. Because of subprime lending, Goldman's Apple Cart business had a loss of about 3% in the second quarter. Now, Goldman provides credit cards for those with lower incomes. Consumer credit is susceptible to the effects of inflation. Credit cards and speculative bubbles will bring a collapse in the financial system. Consequently, those who are already struggling financially will feel the impacts of price increases the hardest. Options misrepresent margin leverage, and just like futures, the VIX may be misleading. This is what Dr. Burry meant when he asserted that market volatility, margin leverage, and consumer credit are all more problematic than they appear to be. Most people have probably pondered whether or not this would be worse than 2008, especially considering the global currency and interest rate trends, banks, and CEOs acting hastily. Given that Michael Burry is frequently blamed for anticipating collapses too early, he has done rather well so far. Thank you for watching this far. Please leave a like, subscribe to help us expand our future audience, and comment down your thoughts in the comment section. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. Stay safe and look out for the next video.